Hello everyone, this is Mark with Semantics Research with the Daily Report. We had quite a choppy balance session today on the ES as the market lacked any direction going into the cash open after the quarter one revision. As the quarter one GDP was revised lower, we are now waiting for the quarter two in August to see if we are truly in a recession. We have also saw personal consumption growth collapsing to 1.8% from 3.1%, which is the weakest print since the lockdowns. Also, something to note is a GDP price index, which can be seen as an inflation number, shows that we rose from 8.1 to 8.2, which is signaling that we may be in a stagflationary environment. We also have New York Fed models showing a negative GDP for 2022 and the year after, which is currently indicating a long-lasting recession. At this current moment, we are down 21% from the highs after half a year. Also in the headlines, we saw that German headline inflation numbers have gone down from 8.7 to 8.2, but that was due to a temporary government relief measures that such as lower fuel taxes and discounted public transports, but that will likely not last. A survey by JPM said that 15 out of 1,500 business leaders in a recent survey, 19% of the business leaders said they are optimistic for the economy into the next year ahead, which is the lowest percentage recorded in the last 12 years. Also, that figure is down 75% from last year. 99% of these business leaders said that their cost of business is higher, and reported labor issues such as recruiting, hiring, and retaining employees came in about 70%. Inflation is currently sitting at a 40-year high, and many businesses are transferring the costs to the consumer. So if the businesses do not think that inflation will last long, they would have eaten the costs, but this is not the case, as many are preparing for a longer-term inflation. 76% of the businesses have stated that they will transfer the cost to the consumer, which indicates this current phenomena. So going into tomorrow, we do have unemployment claims, personal income, core PCE, and end of quarter rebalancing. The end of quarter rebalancing is quite interesting as funds add to winners and cut to losers, and the core PCE is quite crucial as it is a number that the Fed looks at for their policies. We may see some choppy conditions in the market due to PC and other data, and we are also going into a holiday as well, so things could get quite choppy. According to the EIA, we have seen U.S. crude oil refineries increase production and average around 403,000 barrels per day, which is higher than the previous week's average. Refineries are currently operating at 95% capacity, and as a result, we saw WTI crude drop a bit as a result. And this is likely just temporary because we do have the European energy crisis, which does not have a viable solution in sight, as stated by Shell's CEO, that the Russia pipeline gas supplies cannot be replaced effectively with LNG during the winter that is currently approaching. Now, if we take a look at the E-mini liquidity, we could see that the book depth continues to be at historic lows, and despite this, we still have not seen a limit down, and the selling has been quite orderly for the past months. And it is quite interesting as low liquidity generally creates higher volatility, and higher volatility creates less liquidity as participants exit the market. So this ends up being a nasty spiral for the market, and it's hard for the market to get a strong footing. Typically in a bear market, we are likely to see violent rallies to the upside, but you could say that rallies have been quite mild in comparison to previous bear markets in the past. It is pretty interesting to see that all dip buyers have been burned out of existence and people are continuing to add hedges or lighten positions. It seems like there is also a lot of risk unloading at the current moment, so things can get quite interesting after the holiday. Now, going to the bonds, we can see that we had an awful year for the bond investors as rates have skyrocketed much higher this year. The front end of the curve has jumped 238 basis points in the 1-year treasuries and 199 basis points in the 5-year. While in the long end of the curve, the 10-year is only up 168 basis points in comparison. Also, according to the IFMA, the issuance of new debt has been down dramatically year over year, which is down 45% for mortgage-related debt and 23% for corporate debt. Treasury issuance is only down slightly, however, from the 2021 highs, and it is still double of what can be seen in the last decade. From one perspective, you could say that this issuance slowdown can be a trend towards normalization, but on the other hand, the existing debt needs to go somewhere, so whether it runs off over time as the Fed plans or being refinanced at higher rates, which is a tendency in the corporate space. And we still have much uncertainty due to Fed policies, inflation prints, and midterm elections, as there is a coordinated central bank effort to continue to fight inflation with hawkish policies, and it is likely that investors will need to shorten duration and go into defensive sectors for the time being until we go into the expansion period again. Going on about the supply chain, we can assume due to the bullwhip effect, it is likely very difficult for firms to predict supply and demand, and as a result, we will continue to see supply chain inefficiencies and inventory swings in response to shifts in consumer demand. At the current moment, we have firms who have loaded up with excess inventory having to unload their inventory at a discount due to the waning demand from the economic conditions deteriorating, and we will likely see issues with quality, higher expenses for firms, and increased raw material costs, lengthened lead times, and lost sales as an effect of this. And we are currently seeing corrections in the commodities as well as due to lower demand, and we are seeing an unwind of speculators who have jumped into the commodity space, who are betting on faster inflation earlier this year. And as a result, we are seeing a deflationary pulse from this currently, and perhaps this will convince the Fed to ease off the gas pedal a bit going into later FOMC meetings. And perhaps this is where we can see a churn, and if the economy goes into recession, then this can be a potential bottom signal if we see a rather mild contraction and not a very deep one. And then you'll probably see the market look forward to an expansion period of the economic cycle.